All right. Hopefully you can hear me. Oh, maybe a little loud. Give me just a second. I forget where I see any questions. Make sure people can hear me all right. I think we're good to go. Chat, screen share. All right, let's get the screen up. Let's see. Share screen. We are screen sharing. Okay. The chat thing is still loading. Let's see. How can I make sure you guys can hear me? Hopefully everything's good. I will assume that everything is good. And I'm going to get started here. We have on the screen just showing some charts there. Today we're going to talk about order types and specifically when you would use different order types. Now, if you're brand new to investing or trading, then this is going to be probably a huge help to you. We'll have some slides at the end that you can take with you. Do a screenshot. But if you have some experience, I'll bet you I cover a few things that you maybe have never thought of before. So we're going to dive right in. Last week we did, and actually if I can't see any chat or anything, maybe Sergey, if you get a second, maybe you could send me an email or a link to the where I can see the questions if there are any, like last time. But last time we covered strategies. We talked about some different ideas, different reasons you may want to be long at different points, what causes people to buy. Pretty cool webinar, and we're going to follow up that this week with the types of orders that you'd like to probably use. Oh, thanks. Perfect. Okay, now this market, if you're following along, the stock market has given so many opportunities for the different order types. Now, whether you're a day trader or even a long-term investor, the types of orders have really come in handy this year so far. Now, there's a few things we're going to want to consider, but as we go along, we're going to cover each different order type, of course, and apply them to individual strategies. So, perfect. Thank you for the chat thingy there. And let's get started. All right. You can see on the screen here, we're going to use charts. We're going to use visual as much as possible. We know we have a couple choices. Most of us, everybody should be familiar with buying a stock. We're getting long. That's another term that we use sometimes. And there's different ways that you can buy a stock and different reasons that you might want to use different orders. But we can also be short. And we're going to kind of save that till the end just so we're comfortable with all the order types. But we know that we can bet on a stock going down. And maybe that's your belief in the markets or individual stocks. The order types will, of course, apply, but there's going to be a few different variables there. So what we'll do is we'll start on the long side. And I'd like to go back to last week's. We'll kind of review in case you missed it. But I'd like to add on to it as we go. So we're going to just kind of keep building while we teach new topics. So let's just start with the idea we want to get long. It can be any symbol. We're not making like individual suggestions or anything. It's just let's pretend the idea is we want to get long. Now last week we said there's different points you might want to consider getting long to make sure you don't overpay and make sure that you're getting the price that you want for whatever your belief is. And we covered the idea of a pullback, meaning like this over here, where a stock has some kind of move that catches your attention. And you say, well, hey, if I could get a little bit of a discount, I would be a buyer and hopefully catch the next move up. So that was one strategy. The other one was the breakout. And that one really is going to apply this week because that's a completely different order type. Now, last week we just gave the idea of how you would kind of identify a breakout and at what specific point would you be interested. So let's dig into the actual order types here. So let's start on the buy side. We're going to start with a very simple one, and you'll hear people say it's a market order. We don't always say that it's a buy market order. It's just assumed that if you said, I want to buy this stock, I'm going to put a market order in to get long. there's a couple things you want to think about with this one. A market order on the platform, remember the platform is just executing whatever instructions you give it. And a market order is saying, if you want to buy the stock right now at the current market price, we're going to go try to get it for you. The platform is going to say, okay, the market price for, let's say the SPY right now, is 238.25. And it's going to say, we'll do our best. We're going to get out there and try to get it for you at the 238.25. But if it can't get 238.25, your instructions that you've given to the platform are, I'm willing to accept 238.26, 27, 28, 29, 30, and so on and so on. You're telling the platform, I will pay whatever price you have to get me in. So right away, there's a little bit of concern. Whenever you teach someone about order types, you say, okay, careful with the market orders, because you're telling the platform any price, wherever we're at right now, all the way up to infinity is okay. I'll take anything you can get me. What are the odds that you're actually going to pay infinity, right? It doesn't happen. But you want to be careful here, because if you're trading certain stocks, you may end up paying 10 cents more, 50 cents more. It could be ridiculous depending on the symbol you choose. And I'll show you a few examples. So a market order, I always tell people, be certain that you know the volume of the symbol that you're about to buy. Now, this just kind of comes with experience, but we can also reference the charts as well. Something like the SPY, plenty of volume. You could do market orders all day long on the SPY and always get within a penny of whatever the current quote is. Now, I'm not too familiar here with how this, let's see, go over here. Okay. I think next week we'll be using a better platform, so bear with me here. But what this is showing you at the bottom, and it's going to move kind of quick, so you don't hold me to individual numbers. We have a left side and a right side. And this could be a whole class in itself, but this is just called the level 2. And all it's showing you is, on the left, the highest bidders. Imagine that these people over here are names. We all have, first names. Just pretend these are first names for now. And it's saying, hey, this guy up here is the best and first in line to bid for the stock. And he's bidding 238.19. On the right-hand side, we have a whole bunch of groups of sellers. These are all their names. And they're willing to sell at this price. Now, one of the biggest keys here, if you're going to use a market order, is the far right-hand side. And you don't necessarily need this level 2 thing, but for today we'll use it. These numbers over here are showing you the number times 100 of shares that these people are willing to sell. So we've got a whole group over here, and you see 17, 20, 15, 13. So 2,000, 600, 2,600. There's 10,000 shares right there. So that's showing you that if you were to be a buyer of 100 shares, there are plenty of people over here willing to sell to you. Now, if we took the platform and we said, okay, we'd like to execute a buy order at the market, our order would go in. We would immediately go to the front of the line, and let's say it's just 100 shares. It would be an order to buy 100 shares at the first available offer price, or whatever it takes to get filled. So the computer would say, okay, you got it. I'm going to go get you filled. The current best price is 238.23, and here's a guy with 10,000 shares. You only want 100. You got it. You would instantly be filled at that price. Now, that's fine on something like this, but if we look at symbols that do not have this tight spread, that's what we call that, the difference between the bid and the offer. When it's only a penny, we say that's a really tight spread. You can always get filled at that penny, or right there. If you changed your mind and you said, I want out, and I want out at the market price, you can see there's only a 1 penny difference. So certain symbols like this, or like Apple, any Goldman Sachs, big name stocks, they're going to pretty much have tight spreads like this, and market orders should be fine. Now, I'm going to try to find a symbol that does not have a tight spread, and it might take a couple. Oh, no, we got it right here. So let's look at this symbol. For whatever reason, say you want to get long on this symbol, and let's just keep using the 100 shares for an even number here. Here is a huge, huge difference. You see the price. You say, all right, well, 129.16, and you want to get in. And let's say you choose buy market order. Well, the platform is going to say, okay, I'll do my best. I'm going to go out here and find the sellers, and I'm going to attempt to buy 100 shares at whatever the best price I can get you is. Notice already the difference. Now, this isn't too bad. We have the highest bidder at 129.12, but we got to go up a few cents to find someone only willing to sell 100 shares at 129.18. So if you put a market order in, you're instantly going to get filled at 129.18. But the last sale price was 129.12. Technically, that means you're going to have a small loss to start the trade. This isn't so bad. Now with 100 shares, okay, it's probably fair. You know, some stocks trade like this, and you either accept that and participate, or you don't like that and you move on. Here's the problem. I think many people over time are going to learn to trade more and more shares. And if you're used to trading a symbol like SPY, and you say, cool, I'm used to trading thousands of shares now, no problem. You get in and out with market orders as you please. You've got 16,000 shares, 1,500 or 12,000 shares, no problem. The problem is when people get comfortable with that, and then they switch to some other symbol and they say, well, here's one today. I like the way this looks. Let me buy 1,000 shares. We got a big problem now, because a market order will take whatever it takes to get you filled. So it's going to give you 100 at 12, another 100 at 12, there's another 100, then it's going to go to 13, 17, 20. It's going to keep going. You're going to end up having an average price somewhere in there, but it's going to take all of these people to get those 1,000 shares. If you had 2,000 shares, you could see how you're just going to pay more and more and more to get in. So, simple one, the buy market order, very simple order. The key to it is volume. Pick a symbol. If it happens to be, you know, Microsoft's another great example. You can buy thousands of shares or sell thousands of shares at the market all day long, no problem. Very tight bid and ask. It very rarely goes more than 1 penny, so it's always going to be that penny. And there's usually thousands of shares to choose from at each individual price. So the market order, very simple. Just if you're taking notes or you want to remember something from this, just volume. So if you're thinking market order, volume is the key. And I got a slide at the end that I'll let you, you can take a picture of. So that's the first one. Now, when would we use a market order? Pretty much it's just going to be to enter a new trade or to exit a trade that we're done with. Now, preferably we're going to use another type of order to exit a trade, but remember, high volume stocks, feel free to use the market orders as much as you want. One other reason you might use a market order is to cover a short position, but I'm going to get to that at the short portion of the class. Okay, so I'm going to get rid of this for a second. I think we understand the market orders pretty good. Let's move on here. What happens if you're a short-term, long-term investor, and a stock like Microsoft comes up on your list, and you have a job? And so each day you check on it and you say, well, you know what? I would be interested if I could buy it where we talked about last week, down here at that moving average. And we don't know that that is the best place. Oops, sorry. We don't know that this is the best place, but we know that this area right here at least helps us feel like we didn't overpay for the stock. Maybe these people up here have overpaid. We can certainly go back in history and see people that didn't buy near the average price tend to have overpaid. You can see what happens there, and so on and so on. So you're a long-term investor and you say, look, I got to go to work, but I am interested at, say, 66.70. So you can put an order in and go to work. Each day you could check in on it and see if you need to raise or lower your price. But what we're going to talk about now is a limit order. All right, so this is really going to benefit people that are in that kind of situation. Okay, so I'm going to stick with Microsoft. Let's go with the 66.70 number and we say that's where we want to be. A limit order is going to be defined to the platform very specifically. We can use the level 2 again, but you see these people over here that are down below. I wonder if I can expand that. Nope, that's as far as it goes. Okay, so everyone that's sitting here NASDAQ, ARCA, BATS, all these names. They're saying, I'm willing to buy 1,700 shares, 18, and so on and so on. Only if I can get it for $68.84. They're not willing to pay the $68.85. They want someone to come down here, use a market order maybe, and sell to them. No problem. That's a limit order. Now, we had said over here 66.70. If we were to go into the platform and say we would like to buy for the limit price of 66.70, you can see we'd be all the way at the bottom, right? We wouldn't even show up on this screen, but our order would just be hovering down here somewhere, and the platform would say, I'm not willing to do anything for you unless I can do it for you at 66.70 or better. So people always kind of miss that or better part. Something like Microsoft, if it were to drop to 66.70, more than likely that's the price you would get, no problem. However, if there was such a time where Microsoft was coming down, and let's say there was some bad news, and overnight the stock gapped lower. If you're familiar with a gapping stock, it's just where the price change from the close to the next open is different. It could be different by positive or negative. It just means that it starts the day a little lower. Like this over here. Something happened. They reported their earnings apparently. And from the prior close to the next day, that's a gap. It just, boom, starts up at that price and that's it. So let's say you have your order 66.70. It's coming down. All of a sudden, there's some kind of bad news and it opens at 66. The platform is going to say, well, 66 is better than 66.70. So I'm doing you a favor. And so if you're not there to change the order or whatever, the platform is going to fill you at that, whatever the current price is. So you may actually be able to do better. It's very rare, especially on symbols like this. But if they have earnings coming up, that could affect your order type. So keep in mind that a buy limit order, it doesn't mean the exact price. It means that price or better. And better would be anything under whatever your average cost is. So 66.70 or anything better. For something like this, that's only going to apply to a gapping stock. That would be pretty much it. If someone had that limit order, like I said, 99% of the time, probably even more than that, you're just going to get the limit price that you want. All right, so that's a limit order. Now, one key here is if you want the order to repeat itself every single day, then you're going to want to select what's called good till canceled. There's two main ways that you can tell a platform to hold your order. You can say, I would like it for 66.70 and only today. If for some reason it comes down today, that's the only time I want it. At the end of the day, if it doesn't hit that order, please cancel the order. So you don't physically have to do it. The platform will do it for you. Any platform. If you want the order to remain in place day in and day out, then you're going to choose what's called a good till canceled order, or it'll show most of the times as a GTC. All that means is, okay, we're going to leave the order here until you tell us otherwise. It could be 30 days from now and the order will still be good. One little side note, you might want to check with your brokerage firm, whoever you're using, because some brokerage firms have a little safety net for you. And what it is the order may be good till canceled, but for 30 days or 60 days. They won't let you leave it in there forever, or they'll just ask you to check in on it. That's kind of a nice safety net, but otherwise it's good until you physically go in there and cancel it. So as an investor, someone who's, you have a job, you're just looking to buy on dips, whatever it is, you're going to use the good till canceled orders. Day traders only use the good for the day orders, of course, and that's pretty much the spread. That's, day traders use that. Anybody else will use good till canceled. All right, so that's the limit order. Now, what about volume on a limit order? Is that important? I made a big deal out of the market order. Volume should be your #1 concern before you place any market order. But a limit order, is that going to matter? The limit order to buy on a pullback, not such a big deal. We're using it to enter a stock at the price that we choose, but it really doesn't matter if the volume is something like a Microsoft, many millions of shares a day, Or if we go back to that one symbol, Ameriprise. Yeah, this was the one. If we go back to something like this where there's pretty low volume, not such a big deal, because remember, we're buying from someone who's just going to shoot us that order. They're going to sell us at our price whenever it comes to it. So this is one where I would say, don't worry so much about volume. Of course, we all want to trade higher volume stocks if possible, but I'm not going to make a big deal out of the volume on a limit order. Okay, so that's the buy market order and the buy limit order to buy on a pullback. So specific strategy there, of course, is just like as we talked about on Microsoft, where we're trying to buy based on what we learned last week, just at an average price or better. Okay, we also talked about last week the breakout and covered a few examples of what that means specifically, when we'd be interested in a breakout. And now we want to talk about buying on the way up, because remember that breakout, we'll use this for our example. We used a few different names last week, but pretty much any popular stock this year you can find a breakout on just one of those years. So remember the breakout, we've identified at least two different areas where a stock seems to have some trouble. And let's say we're looking around, we're right here. We see the problem, we see that it can't get over it, and we say, well, hey, if it gets over that, then that means the problem is done. I mean, people have gotten excited, they're willing to buy again. Great. In this case, you can't put a limit order to buy because the stock's going to be moving away from you when you're making that decision. So we need an order type that's good for that. But we don't know when Microsoft or any stock is going to break out. All we know is the price. So we look here at these highs and say, where's my high button? So the high, let's say it's 61.50. So we know we want to buy over 61.50, but is it going to be this day, this day, this day? We don't know. So we need to have that order ready to go for whenever the moment is, especially if you're not a day trader, you're checking in once a day or something. You might be out and about at work or whatever and still want to participate. So in this case, the order is called the buy stop market order. And now we're going to use a lot of words that probably they really are very confusing, to be honest with you, but let's go over it. A buy stop market. What this is telling you is there's a price that I want to buy at, okay? And the platform is going to ask you, you'd like to buy the stock? What's the price that you want us to try to get you? You're going to put in a price, in this case, 61.50. Now, remember the third word, buy, stop, market. That third word is exactly what it says. It's a market order. So the instructions that you're going to give the platform are, I would like to buy Microsoft at 61.50, but I'm willing to make that buy order a market order only when it gets to 61.50. So the platform is just going to sit back and wait and go, okay, he wants to buy at 61.50. We will place a market order for you once we recognize the number or the current sale price to be 61.50. It doesn't mean you're going to get 61.50. It means that it's going to start trying to buy it at 61.50. Then it's going to go 61, 51, 52, 53, 54. It'll keep going until it finds you those shares. So anytime I use the word market order, whether it's to buy, to sell, or to short, volume. All I want you to think about is volume. Just remember me saying volume, volume. Very, very important here, because you are not the only one that's going to be interested in buying Microsoft at 61.50. You can see just throughout that day and throughout the next couple days, there were other people interested as well. So if at 61.50, anyone who knows what a breakout is says, deal, I'm in. Think of the orders, the volume that's going to go through. Here's the day that actually did it, and it was bigger than the past couple days. So this wasn't an amazing breakout, but there was still an additional amount of volume. And if we were to zoom in on this day, I'll bet you most of the volume came near the top or near the highs of the day. So on a stock like Microsoft, remember, we can look and say, okay, if there's a breakout and we want to buy 100 shares or 500 or 1,000 shares, it shouldn't be any problem at all. We should probably get that 61.50 or something very close to it. Not going to be the case on that other one that we just talked about, AMP. All right. Oh, let's go back here. Here's a great example of one on AMP. So there's this breakout. And of course, this is all hindsight, so nobody knew that this was going to happen, but it did. And look what happened on the day that it broke out. Okay, great example as far as volume. It started a little higher, so here's that gap up, right? A little bit strong. And then as soon as it broke above, look at the volume down here. It's the biggest one on the chart. That's incredible. That tells you that everybody else that plays breakouts came over to this symbol and decided to play. Notice what happened though. That's a wild day. Remember the bars that we showed last week? If you were around, we showed what different bars mean, different candlesticks mean. So this was a massive amount of buying on the breakout. Well, if you were to use a buy stop market order, which it looks like a lot of people did, you had to not only chase it higher, and there's that wider spread, but because there was so little volume at each price here, going all the way up, there's this massive flow of volume going in. That can be tricky. So if you had your buy stop market order here at these highs, chances are you didn't get filled at those highs, meaning the shares that you actually ended up buying were quite a bit higher. That's because of the low volume. So I don't mean to kind of beat this one to death, but this one's for the newer investors. Please think about volume when you use your market orders. Whether you're day trading or whether you happen to be a longer term investor, it doesn't matter. You got to be careful with that volume. The good news is no matter what type of trader you are, there's hundreds of stocks that do not look like this, that are very thick, filled with volume, and shouldn't be a problem. Okay, so a buy stop market order, you're just putting in a price that you want to start buying at, and you're telling the computer or the platform to just go for it and buy until you fill my entire request, buy at whatever price you have to buy at. That can be a good thing, but on a low volume stock like this, you can kind of see, at least for that day, it was a pretty scary thing. Okay, and of course, we're using the buy stop market orders for entries. That's pretty much the only time people like to use those. Okay, now the last one that we'll cover here is, and this is a great chart to use this for, is the buy stop limit. Okay, and I don't mean to, don't get confused or freak out yet. I have a slide that kind of sums all this up. A buy stop limit order is great for stocks that have sort of iffy volume like this one, or maybe we would even say this is kind of a low volume stock. Let's talk about what the platform says. You put in an order that you'd like to buy this symbol at a certain price, but you'd like it to be a limit order. So buy stop limit. Platform knows buy, he's going long. Stop means we want to, it's funny, but stop actually means we want to start the order at a certain price. So that's what the stop part means. Limit means you have a limit as to how high you would like to go. So a market order is saying, just do whatever you have to do. Buy it until you get me filled. But a limit order now is going to say, start buying at this breakout point and chase it a little bit, but I want you to stop trying to get me filled if you can't do at least a certain number. So let's do specifics here. If we go back to this breakout, there we go. The high was 117.50. Let's say that's the high. So you put your order in that you'd like to buy at 117.50. Start the order, start the actual process at 117.50. Then the computer is going to ask you for another number. So you're actually going to put two different numbers into this equation. You're going to say start at 117.50, and then it's up to you to pick a number somewhere above that you want it to stop. And maybe in this case, you'd say 50 cents. I'll take 117.50, anything all the way up to 118. But if you can't do it for me in that 50-cent window, stop all buying. So what usually happens is 117.50 comes, and if you had 500 shares, you might get some of them. If you don't get all of them, you might get 200 shares, and then the stock shoots up so quick, and in this case, that it hits the limit, the highest price you're willing to pay, and everything shuts off. Okay. Now, if it happens to come back, you might get those other shares. That's if it comes back. Like today, on that move right there, it may have come back to get you. But if not, if it just blasts off and goes higher and higher and higher and higher, you're stuck with whatever you have. Right? So the bad news is you might not get all the shares you want if it's a lower volume stock, The good news is you're not going to end up paying a couple dollars more for a breakout just because you used a market order. So this one's pretty cool. And the buy stop limit orders, we're only going to really use those if the volume is questionable. So this to me is a great stock. I would look at this and go, volume is questionable. I would worry if 5 other people somewhere on the planet decided at the same time that I decided to buy 1,000 shares, we would have 6,000 shares hitting this at the same time. This stock can't handle that. We would all be paying a lot more. So in that case, I would use a buy stop limit order. Take an extra second to take a look and see where you want to start, how high do you want to pay, and then push that off to the side and wait for the breakout. All right. So those are really the buy orders at this point. Hopefully I didn't confuse you. Type something to me. If I did, I can review anything that you like. But those are pretty straightforward. Usually the buy orders, we're all familiar with buying stocks. No problem. We kind of get that. What I'm going to do here is just put in this PowerPoint. Hopefully it shows up nicely. Yeah, it looks good. All right. So I made a little slide here for our buy orders. We covered the buy market, right? That's just saying buy at whatever price you have to buy at and do it now. We're going to use those for entries or to cover short positions, and only want to use them on high volume stocks. We do not want to consider these orders if the volume is questionable. Okay. We talked about the buy limit order. Hey, what happens if you want to wait and let the stock come to you? You want to pick your price. That's a buy limit order. And we're going to use that to enter any stock as it pulls back. And these orders are good for any type of volume. You probably don't have any reason to be concerned. Any reasonable stock, I should say. NASDAQ 100, S&P 500, any of those stocks. Okay, we did the buy stop market. This is used for breakouts. Very popular order for breakouts. So we're going to be using it to enter that position. And I'm hesitant to even put it on these mid-volume stocks, but if you're comfortable with it, you can include it. I would pretty much just suggest you only use them to play breakouts on higher volume stocks, right? And all you have to do is just check and see what kind of volume is trading. Then lastly, we have that buy stop limit, the most protective pretty much of all of them, that's saying I'm going to go ahead and try to buy at a certain point. If you can't do it for me by my limit price, then don't do it at all. So we're using that for an entry. And you can use them on higher volume stocks if it makes you comfortable. But really, these lower two here kind of do the trick. Okay. So those are buy orders as they apply to things that we taught last week. If there are any questions, now's the time before we move on. And grab a snapshot of that if you want it. Just going to grab a drink. Beautiful. Okay, let's go to the other side. Let's say we used one of these orders and we now have a position. So whatever it might be, you place that order. The stock is either working in your favor or maybe not so good. And now we want to place an order to either protect that existing position or protect possible losses in case we're just wrong on the trade and maybe it doesn't work out. So now we're going to go to the sell side. The first thing and the most obvious order is a sell market order. Okay, it's the exact same thing as a buy market order, but obviously it's on the downside. So you're going to tell the platform in this case, I want to sell these shares and I'd like to sell them at whatever the best price is you can get me. Right? So I'm going to go back to Microsoft. Pull this guy up here. Perfect. Okay. Let's say you own Microsoft, you think it's a little overdone, you have some profits, you want to get out. A sell market order is going to get you to the front of the line immediately. Think of it that way. You don't have to wait for all these people. You just jump to the front of the line, go over here, and whoever is at the top of the list is who is going to buy from you. So let's say right now you said, I want out, sell, you would get filled at 68.89 pretty confidently, because there's a ton of volume there. Okay, you can see how quick it moves, by the way. So a market order, if we would have just placed it thinking we were going to get 89, looks like we would have got 87. So pay attention to that. If you have those faster moving, stocks like an Apple or a Netflix, those are going to be really tricky. Okay, now when would we use a sell market order? The obvious one is, hey, we have a winner, right? We had a position, maybe we played a pullback and it rallied. We're excited. We want to take our profit. Cool. You can just sell at any point. Just hit one button. You don't have to punch in any prices on a platform. You just hit sell. And as long as market is selected, it'll go to work right away for you. Another point that you want to consider using a sell market order is when you're in trouble. And it's no fun to talk about these, but there's going to come a point, if it hasn't happened already, that you buy something, you think it's going higher, but it drops to a point where you're not comfortable with that loss anymore. Maybe you wanted to lose a certain percentage or a dollar amount, and you're getting close. So at that point, remember, you have a dollar amount or something you're willing to lose. When you get to that point, you don't really want to mess around with any order types. You kind of just want to get out, suffer your loss, and try to go find another trade. So as long as the volume is good, I would just use a market order and sell. If you try to get kind of cute and you say, well, let me put a limit order, maybe it'll come back and it'll get me out, it usually doesn't happen. It's like the world knows what you're trying to do. So in those cases, for day traders, for the long-term traders, anybody, use the sell market order to just cut your losses and move on. Even if it costs you another penny or two, you'll usually find it was well worth it. It's very rare that you decide to take a loss at the exact bottom. You know what I mean? If you have any experience with that, you know what I'm talking about. Okay, so sell market orders, of course, for taking profits and for taking those stop losses, and highly recommended for taking stop losses, provided that the volume is good. Okay, next up is a sell limit order. Okay, now I didn't say short limit order. I'm saying a sell limit order. So let's kind of visualize this one. Imagine that you played the breakout. I'll stick with the same thing here so we can kind of just all comfortable looking at the same thing. Imagine you played the breakout and you said, tell you what, if I can make $1, I'm out. Well, at the moment that you put that buy stop order in, and because it's Microsoft, you can do a buy stop market order. At the moment you get filled, you can then go into the platform. You don't have to wait and say, okay, I bought at 61.50. If I can get 62.50, I'll take it. Whenever it happens, I'll wait a month, I'll wait a day, whatever it takes. Well, in this case, you're putting your order ahead of what hasn't happened yet. So you're telling the platform, I'd like to sell up here at 62.50, but don't do anything until it gets there. I don't want to sell anywhere lower. I don't want to sell anywhere higher. I want to sell there. So this would be a good till canceled order. And the platform is just going to say, you got it, 62.50. We'll be waiting for it. Go ahead, go to work, do whatever you got to do. But remember what we talked about on the other one. If for some reason there's good news and the stock gaps higher than 62.50, let's say it opens at 63.50, the platform is going to say, he wanted 62.50, but we're at 63.50. I can do better for him. I'll take the 63.50. So even though it's a limit to sell at 62.50, anything above that, it essentially becomes a market order and will get you better, so long as it's at least 62.50. Okay, so just kind of think about how that might work. If it shoots up, great. You might come home, see that you got filled at a better price. That's good luck. It doesn't happen a lot, but if it does, that's great. So a limit order to sell does not mean you will 100% get the price that you want. You'll at least get that price, the 62.50, but you may get a little bit better. Not so much on Microsoft, but if you're looking at some of those mid to lower volume stocks, okay, you might be able to get it. So a sell limit order, we're going to use that to take our profits and walk away. That's pretty much the only time we're really interested in that. The price that you're going to put into the computer is generally going to be higher than the current price of the stock. If you were to put a sell limit order, let's use this current price. If you were to put a sell limit order at 68, and I've done this, it's just kind of a silly mistake that we all make from time to time. But you say, all right, I want to sell at 68. And you get confused. And you say, well, I want to put a sell limit order. As soon as you click that button, you're going to be out. And you see your order go away and you instantly kind of know, shoot, I messed up. What happens is you put the sell limit at 68. but the current price is 68.85. So what happens? The platform says he wants 68, but I can get him 68.85. So let me get him 68.85, and it would immediately get you out. So don't fall for that one. If you're going to do a sell limit order, then your price, just verify, double check that it's above the current price of the stock before you press that confirm button. All right. And so a sell limit order, in this case, doesn't matter the volume because hopefully you're selling on the way up. So if it blasts through and the volume just goes crazy and you don't care. You'll take anything over whatever your limit price is. So I don't care if it's high volume, low volume, or somewhere in between. No problems there. Okay. Next one. Sell, stop, market. So what happens, again, if you buy something and it's not working out, but you're not there? You're not around to see it happen. So if you happen to buy something and it's plummeting, well, of course, if you're right there, you hit the market button to sell, you get out, whatever it costs, you're done. But let's say you're at work, you're on vacation, something's happened, and the stock now starts to fall. Well, we're going to use a sell, stop, market in this case. What this is telling the computer is he's happy where the current price is, but if it hits some number, let's say 68, then he would like to sell his shares at the market price. Okay. Now remember, every time I say market, we're going to think volume. Something on Microsoft, sell, stop, markets, no problem. Very rarely are you going to find that you get burned or get a frustrating fill. So the platform will say, I'm doing nothing for him until it gets to whatever price you punch in the computer, let's say 68. But at that very moment, it's going to try to get you 68. If it can't get you 68, it's going to go to 67.99 and try there. If it can't do that, 98, 97, and so on. With a stock like Microsoft, no problem. You'll probably get within 1 penny of whatever the price you put in there. So anytime I say market, we're thinking volume. So I only really want to use this protective order on something I can count on the volume, that it always has good volume for the share size you're trading. Now, of course, if you're trading 100,000 shares at a time, and that's not going to be everybody, probably nobody that I'm talking to today. But if you're trading 100,000 shares, well, Microsoft's going to be a little bit of a problem, right? To do a market order, you will move the stock and you'll get the pleasure of seeing the stock move because of your order. But obviously, if you're trading 100,000 shares, you're probably not here to learn about what types of orders to place. So sell, stop, market, using it for a stop loss, try to pick the high volume stocks. The last one is a sell, stop, limit. Now, this one gets a little bit tricky. A sell, stop, limit, we would mostly use, and I very rarely even use this order type, but we would use it to trail a stock that's winning for us. Let's say you're a long-term investor and you just bought somewhere here on Microsoft. You're worried that maybe that you go through a couple earning cycles. You want to protect just in case there's a big move down. You're doing well. Anybody that bought any stock basically this year, any main stock, is probably doing well. And so now you're saying, I like to protect that. I'm not sure of the volume though, so I don't want to do a market order because I'm not sure. What you're telling the computer here is to protect some of your gains and go ahead and sell the stock if it hits a number, but then stop trying to sell it if it goes under another number. So I'll use this example again. You want to protect your gains. They'll say, okay, if it goes under 68, then I'd like the computer to sell my stock. If it can't get me 68, I'm only willing to go as far as 67.80, let's say. Now, that's probably no problem. I would say almost 100% of the time, not a problem on something like Microsoft. The computer will begin the selling process at 68 and continue it as long as it's somewhere between 67.80 and 68, right? So you more than likely are going to be just fine. But what you're doing is you're putting a cap on it and saying, look, I want to lock in some of the gains, but I don't want to sell it rock bottom prices. I'll just hold it or whatever you're going to do if you can't get me filled within my window. So think of it that way. I'll just put a little guy here. You're defining a window for the platform to work with. Oh, I do that every time. So in this case, your window might look something like that. And that's just your sell zone. So rather than you sitting here every day going, it's getting close, maybe tomorrow, and having to stare at it, you can just put that order in, tell the computer that this order is good until I cancel it, and then it will work within inside of that window. Now I say that this order is only good for trailing profitable trades. And trailing is just a fancy way to say that you have an order that's behind the price. As it goes up, you just raise that order, but it's always going to be behind the price. We wouldn't use this on a stop loss type scenario, because if you're losing and you hit your max loss amount, you don't want to put a limit on that, right? You want to just get out. And if it costs you a little bit more, that's part of the game. But you don't want to tell the computer, I'd like to sell for a loss if it hits a certain number, and then all of a sudden stop trying to sell if you can't give me that number. What happens if it just keeps going and going and going? You might end up with a bigger loss. So we don't usually say to use these for stop losses, but rather to take your profits as something pulls back. All right. Now, of course, you can use this type of order on a high volume stock. You probably don't have to. You could just save a little time and use the market order, but highly recommended for mid to low volume stocks. And so here is the slide for the sell orders. So everything we talked about on the sell side, to sell at a market or to sell at market, we're more than likely just using those for a stop loss on a stock that has volume that we're more than comfortable with. We're going to sell for a limit. That'll be on the way up to take our profit and get out of the stock. We can do that on any, any level of volume stock that we can find. It doesn't really matter. We're going to sell stop market to take a loss, but we really want to focus on those higher volume stocks, maybe not the mid volume. Just if you're comfortable with the symbol and you're familiar with the volume, maybe it's okay. Mostly we want to use these on high volume stocks, and that's going to be to take a loss. We're going to use the sell stop limit as a trailing stop of sorts, and we don't really need to use it on high volume stocks, but you could check that off if you want. But we definitely want to use those on our mid to low volume stocks. All right. So usually people understand the buy orders, the sell orders, not so bad. I'll give you a second if you have any questions or concerns. Next up is shorting. All right, here we go. So this one tends to confuse people a little bit. I'll go a little slower, and we can go over more if need be. When we're shorting, there's a definition that people use for shorting, the general industry definition, which I think is the most confusing definition that you could give a stock or give a term, a trading strategy. Basically, you're just betting on the stock going down. You're going to sell first and buy then later. Whereas most of us are just familiar with buying a stock, and then to finish the position, we have to sell it, whether for a gain or for a loss. Shorting is just, we're going to start by selling. We want it to go down, but we're going to have to buy back no matter what happens at some point. That's how we'll close the position. So just think of it that way. We're just flipping the two things. Buy and sell, we're just flipping them the other way. Okay. So let's pick a stock. Let's pick a different one so we can look at something different. What's popular right now? Apple. So Apple's been an amazing move, just killing it. And even though earnings were not so great, not what everybody kind of wanted, the stock is still almost positive on the day. So here we have this beast of a move. There has to be people that are betting on this thing dropping, right? There always will be someone that says, that's too high. I would like to bet on it going down. Let's pretend that's us today. The first thing we can do is to short at the market price. Now, some platforms, you're just going to hit the sell button, and it's going to know that since you don't have an existing long position, he must mean short. And then some platforms actually prefer this way better. Some platforms have a short button, and you just have to hit that button. I like that better because I see short, and I want to hit the button. So what we're calling this is a short market order. Okay, so for everything that we talk about from here on to the end of the seminar is betting on the stock going down. Now I said market, so first thing we want to do is look at volume. Now Apple, generally, no problem. Everybody trades Apple, right? So if we were to short, we would be going to the front of the line over here and selling to whoever the highest bidder is. Now, there's always plenty of volume here. It moves so quickly that nobody ever wants to put their whole position out there. Meaning, you might see 700 shares, but that's because the guy that wants to buy 5,000 shares is not going to show you that. He's going to do it little pieces. So this stock is very popular for that. If we hit that short market button, well, the platform is going to say, okay, go to the best bidder and let's try to get him 147.08. If for some reason they're not there or we have so many shares, it'll keep going lower this time until it gets you short. So the platform is going to chase to the downside this time. Now, technically, there is a floor that it can chase to. The stock can only go to 1 penny. Right? If it went to 0, the order wouldn't go through. So technically, whereas a buy market order has a limit of infinity, this has a limit of 0. It's obviously not favorable. We don't want that, but you got to know that at least there's a floor. Right? It means your profit's also limited too. It can only go to 0, so you're limited to whatever that is. Never happens, but maybe one day it does. Okay. So short market order, you're getting in, your order will only be profitable, your position will only be profitable if the stock drops, and a market order is going to say, whatever it takes, chase it as low as you have to get me in. So definitely want high volume stocks there. A short limit order is, is the exact same thing, only we're saying we'd like to limit the price that you chase. Go ahead and chase it up to some point, but then we're going to actually specify what point we want you to stop chasing the stock. Okay. So market order, probably fine on Apple. If we go back to that other one, if you were to short this stock, if it's 100 shares, maybe not a problem. Remember, you're thinking 128.88, you're going to actually get 82 or lower. So 100 shares, probably not a problem. If you're trading more than that, very, very careful using a market order here. This is where you would want to limit the price that you're willing to chase to. Okay, so it would still be an entry position, but we're going to limit it to whatever you choose. So, and that one, the platform is just going to ask you for one number. You want to short now, but I want to stop shorting at some magic number, and you would just punch in, say, 128.68. Don't go any further than that. Okay. Now we have the two that really confuse people. The short stop market. The short stop market order, we'll just use one strategy today, and we're going to say that's a breakdown. Now, breakdowns are very hard to find right now because everything seems to be going straight up. I actually don't have, let's try some of the beaten up stocks. I don't have a good one there. You got Lulu. What's the, maybe Twitter from a while back. All right, well, because everything is straight up, I have very poor examples for breakdowns, but let's use this one here. Here's a stock that touched whatever number this is numerous times, and for some reason could not get below that. Now it did eventually get below that. So if you saw this around here, somewhere at the beginning of the year, and you said, you know what, if it goes under there, I'd like to short it. But I have a job, I got places to be, so I'll put my order to short anything under this price, and I want to place it as a market order. So the platform is going to say, do nothing. All through these days here, your order would just be still there. And then as soon as it went under there, the platform would say, get him short at whatever cost. If you have to short it at 1 penny, so be it. So it's going to start at 16, then go to 15.99, 98, 97, and all the way down. Short market order. Volume, very important on short market orders. Here's what happens. When you short a breakdown, let's say under this low, the point where you're getting in is the exact same point where people are admitting their loss. Everyone is using, that's long, is using this as a stop loss. So while you're shorting and starting a new position, you have a pile of people selling they have their stop market orders in as well, only to get out of a position. So it becomes this flood of people rushing to get out, in addition to you thinking, well, this is great. This is an opportunity for me to get in. All of those people and you are sellers. That gets to be a little bit chaotic. So I'm very cautious to suggest using short stop market orders on breakdowns. I think if you're not there staring at it, maybe breakdowns aren't your best strategy for anyone that has a job that can't be around to stare at the position. Okay. So, but that's a stop market order. Volume, very, very important. Now, you could choose a short stop limit, which is kind of, you're starting to see the pattern here. We're covering all of them. This would just say get him in once it goes under, but you'd have to specify some number that you want it to stop at. And this is a great example actually for this, because what happened? It didn't ever go to this number. When it broke down, the low here is 1616. It never actually went to 1616. It just opened the day down here at 1596. So if you had a short stop market order at 1615, you didn't get filled there. If you're very lucky, you got filled down here at 1597. More than likely, you got filled a little bit lower because it's a market order. It's just going to chase as far. All it knows is the event has triggered, start getting them in. Now, if you had a limit order at 1615 and you said, I'll chase it all the way to 16, you didn't get in at all. You came back and you probably wondered why nothing happened. My order is still there. And that's because it didn't go there. It skipped all of that and opened lower. So here's a case where you might be disappointed because you had a limit price that never touched, but yet the stock went lower. If your limit price was wider and you were willing to chase further, then you got filled at the lower end or closer to the limit you were willing to short. That's a big difference there, right? So here's a great example of that. A short stop market order might have made you pretty mad if you played that breakdown. Short stop limit could have also frustrated you because you didn't get in, all right? So that's the short side orders. And here we have the slide. Short market, we're using on entry only on high volume stocks. Short limit orders, we're using an entry as an entry position for anything. Doesn't matter the volume, whatever you're comfortable with. Short stop market, we're using to play breakdowns in today's example. I'm highly recommending that you only do it on high volume stocks that you're comfortable with. And then if you're unsure, you can always use the short stop limit to kind of protect in case there's some massive move you're not comfortable with. And at the very minimum, please use those on mid to low volume stocks. All right. Well, that's a lot. I know we've covered a lot. It's not the most exciting thing to cover, but it's going to save you if you just spend some time getting used to the different order types and more specifically how to find them on your platform quickly. Because it seems that when you need to place an order, you usually feel like you need to do it quickly. So we don't want to get tripped up on some of the terminology here and accidentally put the wrong order in there. All right. If you have any questions, now is the time to ask. I will also suggest that you visit our website. Keep in touch over here. You can send us an email. Check us out on social. Lots of great articles. I write a bunch of articles a week on there. I have it translated now, but of course it is in Polish. It would be on Polish on your screen. And there's just an unbelievable amount of things on here, from all the different articles to the latest stock, like the hottest stocks, most active stocks, just tons of stuff. So please check that out and keep in touch with us. Let us know if there is anything that you'd like to hear about. We do these webinars every 2 weeks now. If there's something you feel like we could cover and would like to know a little bit more about, please let us know. I'll leave this up. I will stick around for a second in case there are any questions. I believe I have the right window open. If not, have a great rest of your evening, and we'll talk to you soon. Well, it appears I did a great job. There are no questions. Perfect. Can't beat that. Oh, there's one. Can you explain the definition of volume, high, mid, pretty new. Yeah. So, well, here's how I'd look at it. I'm going to pull this down. If you have heard of the stock before, you're probably okay. And I know that sounds silly, but I try to use the names that we're all familiar with, because for newer traders, you want to stick with the names that everybody else is trading too. And it's how you're going to get the most activity and not have to sit around for weeks and months waiting for something to happen. So I use things like Twitter. I know that's popular. Netflix, of course, is a popular one, a little pricey. But if you've heard of the stock, then chances are the volume is fine. Another way that you can kind of reference that is just by looking at the quote. If you look at the quote and you know your size, like you know how much you want to trade, maybe you only trade 50 shares at a time, and maybe you trade thousands at a time. So just take a quick look over here and pretend for a brief second that you're about to buy at the market. And you know that means I'm going to jump up here and it's just going to fill you until, keep buying until it gets you all those shares. If you know you're going to buy 100 shares, no problem. If you're going to buy 10,000 shares, you would look at this and say, that could be a problem. I probably don't want to use a market order. Let me do a limit order or a couple limit orders so people don't get scared. That's how I would look at it to start. A lot of people try to use a number and say, well, the stock should trade at least 1 million shares a day or whatever. But that's kind of vague because it could trade 1 million shares because it's going through a merger with somebody. There could be any number of reasons why it temporarily trades a lot of shares. All you're really concerned is, at that brief moment that you're looking at the stock, can you get the order filled? And in this case, with a couple hundred shares, I would say, yeah, no problem. Another thing you can do is take a watch list and sort it by, say, the S&P 500. I'll just do that. These are most of these are going to be just fine. The NASDAQ 100, those are also going to be fine too, as far as volume that should be able to get you in and out, no problem. Yep, so the volume, oh, that's a good point. When I say volume, I made the assumption that I was using the right terminology. Volume just means how many people are participating or willing to participate. So all we're looking at here are the people that are willing to buy and the people that are willing to sell. They're also sharing the number of shares that they're willing to buy or they're willing to sell. So you're looking at that level of participation. If you only see 2 lines on this side and 2 lines on this side, that's 4 people. Let's say it that way. There's only 4 people. So the level of participation you would automatically assume is not very good. So that's it. Yeah. It's just going to be the number of shares that everybody's willing to buy and sell if they get their price. Yeah, great question. Sorry, that's great to clear that up. Perfect. All right, I think we did our job here today. Enjoy the rest of your evening. We will be back soon. Remember to leave us some comments or get us any questions on the website, and we will see you next time.